Welcome to Black Letter Money. November 22nd, 1910. A private railroad car departs Hoboken, New Jersey, headed towards the Georgia coast. Inside, there's between 6 to 8 men, dependent on which account you believe. These are some of the most powerful figures in American finance and government at the time. They are using first names only, no last names, no titles. They have clear instructions. If anyone is to ask, they're going duck hunting. They are not going duck hunting. What they are going to do is over the next 7 to 10 days on a private island off the coast of Georgia will shape the financial structure that every American lives in today. Most people have never heard this story. Let's change that. This is part 1 of a new series, The Built-In Secret of Black Letter Money. So far on this channel, we've covered how the law shapes your money, wage theft, debt law, tax law, but underneath all of that is a system that was designed deliberately and carefully by a small group of men over a century ago. This series is about that system, where it came from, how it works, and what it means for you today. In this video, we are going to follow the facts, not a political agenda, just where the record is clear. And where historians disagree, I'll dive into that too, because the truth on this, the documented, verified, primary source truth, is more interesting than any version that requires embellishment. The men who built the Federal Reserve didn't hide what they were doing because it was illegal. They hid it because they knew if the public found out who and what was behind it, it would never pass. They even said so themselves. And that's where we will start. To understand why some of the most powerful men snuck onto a private island in 1910, you need to understand what banking looked like before they got there. Between 1819 and 1907, the United States experienced at least 6 banking financial collapses. These collapses followed a pattern. Banks would overextend and over-leverage, confidence would collapse, and depositors would rush to the banks to withdraw their savings. Once all of the money stored on hand was gone, credit would freeze and the economy would contract. Workers would lose their jobs and savings overnight through no fault of their own. The panic of 1907 was the most dramatic. The stock market lost nearly half of its value. Banks across the country stopped lending. Businesses couldn't make payroll. Everything seemed doomed. But the crisis was stopped. Not by the government, not by Congress, not by any public institution, but by one man, J.P. Morgan, the most powerful banker in America. J.P. Morgan summoned the trust company presidents to his private library on Madison Avenue. He ordered them to open their books. He then locked the front doors. No one left until they had pledged enough capital to stop the collapse. It worked, but it exposed something deeply disturbing. The financial stability of the entire United States depended on the goodwill of one private citizen who had happened to be awake to see what was going on and willing to act. Congress responded by creating the National Monetary Commission. They were tasked with studying the banking systems around the world and recommending reform. Senator Nelson Aldrich of Rhode Island was put in charge. After 2 years of studying and traveling through Europe, Aldrich had come to a realization. He needed the right people in a room to turn these ideas into a concrete plan. He also needed that room to be somewhere where no one would find them. Now here is where the story gets interesting, and where I need to be precise about what we know for certain and what historians still dispute. The Federal Reserve's own official history confirms 6 men at Jekyll Island. 6. Let me introduce them and pay attention to who these men represented. First, we have Nelson Aldrich, Republican senator from Rhode Island, chairman of the Senate Finance Committee. His daughter, Abby, married John D. Rockefeller Jr., the son of Standard Oil founder John D. Rockefeller. That connection would later become a significant point of public criticism when the plan became public, and that he organized the entire operation. Second, we have A. Piatt Andrew, Assistant Secretary of the United States Treasury. His presence gave the proceedings a degree of official government authority. Third, we have Frank Vanderlip, president of National City Bank, the institution that eventually became Citibank. He would later write about the meeting more candidly than any other participant and published it in the Saturday Evening Post in 1935. Despite my views about the value to society of greater publicity for the affairs of corporations, there was an occasion near the close of 1910 when I was as secretive, indeed as furtive, as any conspirator. I do not feel it is any exaggeration to speak of our secret expedition to Jekyll Island as the occasion of the actual conception of what eventually became the Federal Reserve System. And fifth, Paul Warburg, a German-born banker who had an immigration to the United States and became a partner at Kuhn, Loeb & Company, one of Wall Street's most influential investment banks. He had been publicly advocating for American banking reform for years before Jekyll Island, and most scholars credit him as the intellectual architect of what came out of the meeting. He was, by many accounts, the most technically sophisticated person in the room. 18 years after Jekyll Island, in 1930, Warburg wrote, "The results of the conference were entirely confidential. Even the fact that there had been a meeting was not permitted to become public. Though 18 years have gone by, I do not feel free to give a description of this most interesting conference, concerning which Senator Aldrich pledged all participants to secrecy." And the sixth, Arthur Shelton, a private secretary, there to take notes and handle logistics. Now, there is a general dispute about whether additional men were present. Some accounts, including Vanderlip's own autobiography, mentioned a seventh man, Benjamin Strong, then a vice president at Bankers Trust, who would later become the first governor of the Federal Reserve Bank of New York. The Federal Reserve's own history acknowledges this, but concludes it is unlikely Strong attended. No other account places him there, and B.C. Forbes, the founder for Forbes magazine and the journalist who first publicly revealed the Jekyll Island meeting in 1916, did not include Strong in his account. Some sources also mention Charles D. Norton, president of J.P. Morgan's First National Bank. Whether it was 6, 7, or 8 men in that room, the historical record is consistent with who the core participants were and what they produced. One more detail worth noting: access to the Jekyll Island Club was nearly impossible. The club was described in 1904 as the richest, most exclusive, the most inaccessible club in the world. This location was more than likely arranged by J.P. Morgan himself, who was a member. The Federal Reserve's history says most likely J.P. Morgan. So this has not been confirmed definitively, but the evidence is strong. For approximately a week to 10 days they worked, completely secluded, no telephone, no telegraph, no contact with the outside world. What they produced was a detailed plan for a central banking system, what would later be called the Aldrich Plan. The core structure was this: a National Reserve Association, a single central bank with 15 regional branches across the country. Member banks would hold their reserves there, and critically, it would serve as a lender of last resort during a financial crisis, providing the kind of emergency liquidity J.P. Morgan had provided personally in the 1907 financial crisis, but on an institutional and permanent basis. There was one feature with this structure that would later become a significant point of controversy. The institution was to be owned and controlled by the banks themselves. The boards of each regional branch would be elected by member banks, with larger banks getting more votes. It was, by design, a private institution with a public function. When Aldrich presented the plan to the National Monetary Commission in January 1911, he immediately hit a political wall. The Democrats had just won control of the House of Representatives, and they were deeply suspicious. And not without reason. The Aldrich Plan was a Wall Street operation dressed up as a public reform. The plan stalled. Technically, the Aldrich Plan was never passed by Congress. But here's where the story takes a turn that most people don't know. Over the next 2 years, the core ideas from Jekyll Island were reworked, rebranded, and reintroduced as a Democratic bill, the Owen Glass Act. which became the Federal Reserve Act, signed by President Woodrow Wilson on December 23, 1913. The name Aldrich was dropped. The structure was modified. Congress now appointed the Board of Governors, adding a layer of public oversight. But the fundamental architecture, the regional structure, the elastic currency, the lender of last resort function, all came from Jekyll Island. Vanderlip said it himself. The essential points of the Aldrich Plan were all contained in the Federal Reserve Act as it was passed. Modern scholars, including those who are critics of the Fed and those who defend it, agree these two bills are functionally the same despite their different political origins. Wilson signed the Federal Reserve Act on December 23, 1913, using 4 pens, giving one to each of the bill's lead sponsors. The Federal Reserve System had been born. 3 years after the secret meeting on that private island, the plan emerged and was now law of the United States. And here is where I want to be direct, because this story attracts 2 kinds of distortions, and black letter money isn't interested in either of them. The first distortion, treating Jekyll Island as proof of a shadowy global conspiracy to enslave the American public through a privately controlled money system. That goes beyond what the evidence supports. The men in that room had a genuine and documented problem to solve. American banking financial collapses were real, severe, and reoccurring. The collapse of 1907 nearly shattered the economy. A lender of last resort, having an institution that can provide liquidity during a crisis, has real economic value. Every major developed nation had one. The United States did not, and fixing that was a necessity. The second distortion, dismissing the secrecy and the conflict of interest as irrelevant political noise. That understates something very important. These men represented private banking interests, and enormous ones at that. They wrote this plan for a central bank in secret because they knew their involvement would destroy its political prospects. And they presented that plan to Congress as a reform for the public good. The honest take sits between these 2 positions. The Federal Reserve was built by the people who need it the most, the banks. It was designed in part to prevent the catastrophic financial collapses that had repeatedly threatened their institutions. It also genuinely provided a stabilizing function that benefited the broader economy. Whether the balance between private banking interests and public benefit has been struck correctly over the century is a legitimate, ongoing debate, one this series will continue to explore with the same commitment to the actual record. Here's why the history matters today, for your money right now. The Federal Reserve controls the money supply. It sets the interest rate that determines your mortgage payment, your credit card rate, the return on your savings account, and the cost of every loan you have ever taken or ever will take. When the Fed raises the rates, borrowing gets more expensive across the entire economy. And when they cut rates, your savings earns less. Every financial decision you make exists inside this framework that was designed on that island in 1910. The institution that makes those decisions sits in a unique and deliberately ambiguous legal position. It operates under a federal contract. Its governors are appointed by the president and confirmed by the Senate, and it reports to Congress. But it is not a government agency in the traditional sense. The 12 regional Federal Reserve banks are technically privately owned. That structure of publicly accountable but privately organized was designed at Jekyll Island. The ambiguity was intentional, and it remains today. In part 2 of this series, we go deeper into exactly what the Federal Reserve Act changed about the legal definition of money in the United States, and what a century of that system has meant for the purchasing power of every dollar you have ever earned. If this is the kind of thing you wish someone had explained to you sooner, there's a lot more where this came from. Subscribe to Black Letter Money. This is what we do here, the law and the money. Together, explain clearly. I'll see you on the next one.